Ever feel house rich but cash light? What if your bricks could bankroll your bucket list and still leave a legacy? Stick around because I'm walking you through the 4-part reverse mortgage strategy that flipped my entire thinking. I'll share real numbers, big disclaimers, and a mindset shift I didn't see coming. And remember, this is for education only. Always consult a CFP, registered investment advisor, and your CPA before making any big moves. True story, for most of my career, I avoided reverse mortgages like the plague. Frankly, they felt like late night infomercial bait designed to rip off seniors. Then, one of my clients booked a Google Meet with me. He had a 20-page spreadsheet and said, "Andrew, I've stress tested this reverse mortgage line of credit strategy through every crash since 1970, poke holes in it." 90 minutes later, with 2 AI tabs open, my calculator, and a cold brew in hand, I had to admit he out-researched me. Strategy actually made sense. And honestly, most of the best strategies I've learned over my decade of doing this have come from sharp, curious customers just like him. So today I'm walking you through his blueprint. But remember, no YouTube video replaces real financial planning. Run anything you see here through your CFP, fiduciary advisor, and of course your CPA. Think of this as a 4-gear machine. And when all the gears turn together, the strategy hums. Gear 1 is your line of credit growth, and you're going to want to open that line of credit early. Gear 2 is your opportunity bucket. You're going to take a small, smart draw to invest. Gear 3 is your sequence buffer. You're going to tap into equity in down markets. And Gear 4 is your exit plan. Protect your legacy and avoid surprises. Miss one gear and the machine still grinds, but nail all 4 and you unlock something truly powerful. Step 1, if you're at least 62 years of age and your house is paid off, consider opening a home equity conversion mortgage as a line of credit. And there are some cases where you can be as young as 55 for a jumbo reverse mortgage, but we're not going to get into that today. But here's the kicker. Any portion you don't use, it grows. Credit limit grows at about the same rate as the interest and the FHA mortgage insurance. And the earlier you open it, the longer you have that compounding working for you. It's like an emergency fund that quietly inflates. Next, you take a small draw, say somewhere between 15 and 25% of the principal limit, and you invest it. Think long-term portfolio or reliable real estate syndication. The goal, outpace the loan's growth with an average rate of growth of about 6 to 8% over time. Even a modest 2% spread over 10 to 15 years can seriously boost your net worth while the house is still appreciating. In Gear 3, this one's a retirement game changer. When the market drops, you don't sell your investments at a loss. Instead, pull from the reverse mortgage line of credit. It's tax-free loan proceeds, so it doesn't spike your taxable income either. And when markets rebound, you switch back to drawing from your portfolio or repay the line of credit to re-expand it. This buffer alone can stretch your retirement plan by years. Now we come to Gear 4, your exit plan and legacy. When you eventually move, sell, or pass away, the loan gets repaid. No monthly payments required during your lifetime. And because HECMs are non-recourse, neither you or your heirs will ever owe more than what the house is worth. So keep your family in the loop. The more they understand, the smoother the legacy transition. All right, now let's walk through a real life example. Let's say you're 65 and your home's worth $600,000 and it's paid off. You open a reverse mortgage line of credit, and based on your age and current rates, the principal limit's gonna be around $300,000. You take a $60,000 draw, which is just 20% of your line of credit, and invest it. Let's say it grows around 7% annually for the next 15 years. That could grow to about $165,000. Meanwhile, the remaining $240,000 in your line of credit, it sits untouched and grows. At 5% growth, it could expand to $425,000 over the 15 years. And now your loan balance on the original $60,000 you borrowed grows also. Might end up around $140,000 after the 15 years. But here's the kicker. Your home, appreciating at just 3% every year, is now worth around $935,000. So after paying the loan, your family still walks away with roughly $795,000 in equity. And that's on top of the $165,000 you grew from the opportunity bucket. Not bad for a strategy that started with a home that you already own free and clear. A quick detour, this strategy gets even better when it's paired with a Roth conversion. A Roth conversion means moving your money from a traditional IRA to a Roth. You pay taxes now, but everything grows tax-free, and withdrawals later are tax-free also. The problem is conversions increase your taxable income. But if you're covering income expenses from your tax-free HECM, your income remains low, giving you room to do, say, a $40,000 Roth conversion without jumping tax brackets. Remember, conversions are permanent. Surcharges and state taxes can apply, so talk to your CPA. Bottom line is you get more tax-free growth, smaller RMDs, and a smarter legacy plan. And here are some rapid-fire pro tips HECMs for purchase. Downsize, put 50% down and keep the rest invested. Refi hack. If rates ever get around to dropping, refinance your HECM and potentially increase your line of credit. Long-term care backup. That compounding line of credit can be used to fund in-home care later on. This shines for folks who own their home outright, have a 10 to 20 year retirement horizon, want tax efficiency or long-term care flexibility. Probably not a good fit if you plan to move within 5 to 7 years, have little equity, or if you're just one of those people that emotionally needs to feel that feeling of your house being free and clear. And I get it, reverse mortgages sounded sketchy to me too, but with the right structure and guidance, they can be a compounding safety net, a bear market shield, and a tax-efficient legacy tool. Want to stress test your scenario? Let's chat. Book a phone call or a Google Meet using the link below or in the description. No pressure, just data. Thank you for watching. Smash that like and subscribe button, and we'll see you in the next video.